A recent S&P report finds muni bond defaults have declined 50% so far this year. J.R. Rieger, Vice President of Fixed Income Indices at S&P, is the author of that report. He joins us now from his firm in New York. And George Friedlander, Head Municipal Strategist at Citigroup, he joined us in studio to explore what is ahead for this market. Obviously, gentlemen, there has been a lot of debate on this point. J.R., I want to start with you, with your recent report here, which indeed said that we've only seen about 8 defaults thus far this year, or municipalities in default. Explain to us what exactly that means when somebody's in default, to kind of take a step back from this here.
Sure, that's a good way to start. When we're talking about monetary defaults, we're talking about when bondholders have actually missed receiving a promised principal or interest when it was due. And we've tracked 8 monetary defaults so far this year, which is indeed down by half from where it was this time last year. Overall, defaults through 2010 were down in number from the year prior, so the number of defaults seem to be declining. The trend, however, is important to watch in regards to what sectors of the municipal bond market are providing or causing the majority of defaults. And it's not been the general obligation sector of the market that's been creating the most defaults. It's actually been single source revenue bonds that have been the primary municipal bonds that have been defaulting. Single source revenue bonds, so what exactly does that mean? Well, that would be like a land-secured bond issue where the money was borrowed from the bond market, from the lenders, and the money was used to improve the land for development. Roads were put in, water and sewer facilities put in place so that the developer can begin to build homes on that property. The homes are then sold, and then the homeowners are assessed taxes which repay the bonds over time. Those are the type of deals that are leading the defaults, if you will, in the municipal bond market. Single source deals such as multifamily or low-income housing projects, healthcare related deals like congregate care retirement communities or assisted living facilities. They also tend to have a higher default rate than other types of deals. And then there's the corporate-backed or conduit financings where corporations borrow through the tax-exempt market. And it has an economic benefit for the community when they do this because they create jobs and they build factories within the community. But those types of deals have a higher incidence of default than an essential purpose municipal bond or a general obligation bond. So whatever type we're talking about, George, we're talking about $222 million in defaults thus far this year. Yeah. There's a big distance between $222 million and $100 billion in defaults, which is what Rubini and Whitney have talked about.
Now, I think it's important to distinguish between what Whitney and Rubini said. Whitney said hundreds of billions on 50 to 100 large issues, and she made it sound imminent. Rubini said 100 billion over 5 years, and most of those in the non-rated or junk sector. So there's several oceans worth of difference between those two. And Rubini's comments are not that different from the way I would view it. Yes, a lot of smaller, weaker credits are going to have problems. A lot of these are either non-rated or junk-rated. In the rated categories, there will be a very modest amount of default. And as Rubini said, on those types of bonds, the investor gets most of his money back. So he's not talking about a large amount of principal losses in any given year on the kind of paper most of our clients would own.
So how much does
I would certainly agree with that.
How much does all of this come back to the deficits? I mean, this situation is heating up, obviously, in places like Wisconsin, and there are lots of calls for austerity. So why is it just going to be the lower-rated issuers? Why won't it be some of the larger?
Well, I think there's 2 very important points there, or more. But just starting off, there are light years between a budget crisis and a credit crisis, number one. There's lots of budget crises going on. This is a very painful time for state and local governments and for those who depend on their services. Only in the most extreme cases do those turn into payment defaults. Issuers, there are strong legal protections for bondholders. Issuers know that if they don't make payment on their debt, that their future is dire. So it takes a very long time and very unusual circumstances for budget problems to truly turn into a payment default.
And JR, what do you think? Do you sort of project, as well as recording and monitoring, what the defaults have been thus far?
Well, in our role, we're not projecting what the defaults are going to be. What we've been focusing on is what types of sectors are generating these municipal defaults. Now, I've been in the municipal business quite a long time, and municipal defaults have been a part of the world for municipal bonds for the almost 30 years that I've followed municipals. We've always had defaults. Very few general obligation bond issuers are going to put themselves in a position to default on the municipal bonds because, as George says, they'll eventually have to come back to the municipal bond market at some point in time for capital projects and funding for those projects. And if you default, you impact that capability to raise funds in the future. So I think the municipalities on the general obligation side of things are very focused on meeting their obligations for bondholders. Now, this is an unprecedented economic time that we're in, and it's very difficult to forecast what's going to happen. But historically, GOs and essential purpose bonds like water and sewer bonds have had a very low default rate because they need to get this funding in the future for other capital projects that they need to fund. They don't have the funds to do a lot of the capital projects that they have to do over time, and they rely on these markets for the funding.
George, you know, I think you and JR are in the same camp of most of the muni market investors we've talked to over the past several months as this whole debate has been going on. But investors are not convinced, right? I mean, outflows continue from municipal bond funds.
Right.
What's going to turn that flow around?
Well, I think it's important to recognize what happened here is that a combination of several forces came together to cause these outflows. First of all, higher interest rates. Second of all, these dire forecasts in the press. Thirdly, yes, there were budget problems, so people put the two together. And fourthly, with Build America bonds gone, those taxable bonds that took the long end of the muni market and put it elsewhere, it's harder to get deals done, and yields went up very dramatically, over 150 basis points through the peak in January. So that scared people. They're hearing about defaults or projections of defaults. They see their portfolios eroding, and they make a connection. Well, the problems that happened were mostly technical, and were also related purely to the fact that bond flows were so bad that we had difficulty finding a buyer for long bonds.
George, we're going to have to leave it there. I'm so sorry. George Friedlander of Citigroup, JR Rieger of S&P. Gentlemen, thank you so much.